And welcome back once again, options traders. Well, another good question for the group. Which type of leverage are you using? You're going to find out there's really two distinct types of leverage that you can use in the options market. And a lot of times traders unknowingly use a very dangerous type of leverage. So what is it and why does it matter? Well, let's go find out. And before we do, as always, please be sure to click like and subscribe. Definitely very much appreciated and helps to promote the YouTube channel. So in the options market, we have two basic types of leverage that you need to be aware of. One is where you can use options to control the same number of shares. So this is what we might call a safer use of leverage. So for instance, let's say that the stock is trading for 100 and you buy 100 shares for a total of 10,000 bucks. All right, so that's our benchmark, 100 shares for 10,000 bucks. Let's take a look at our first use of leverage with the options. Number one is where you are controlling the same number of shares for less money. This is what we might call a safer use of leverage. So for example, you might be able to buy the $100 call for $2 or $200 total. And if that's true, you are controlling $10,000 worth of stock by only paying $200. So yes, there is some leverage there. But on one hand, it's safer, because instead of having to spend $10,000 for it, you're spending $200, but still controlling 100 shares. What's the second type of leverage? This is the dangerous one. This is where traders can control far more shares by spending the same dollars on the options. So if we have $10,000 that we're willing to put into stock, and some traders will say, not going to put it into stock, I'm going to buy 50 of these $100 calls, and I'm still spending $10,000. And so in their mind, they're thinking, hey, 10,000 bucks is 10,000 bucks. Well, the problem is with the options, if you put 10,000 bucks into that, you are controlling 5,000 shares of stock. And if you're not used to trading lots that size, it can cause really big problems. And so to see why, let's go take a look at it graphically. In black, we have our risk graph for 100 shares of stock at 100. And in blue, we have our $100 call. There's our bend right at the 100 strike, purchase for $2. So that's where this blue line flattens out, because that is ultimately the worst that could happen, is that this just goes flat, you're out your $2. So notice that for $200, you are controlling $10,000 worth of stock. And you can see that by the slope of this black line right here, this angled part, compared to that same part in blue. Both positions control 100 shares of stock, and that's why these angles or these deltas are identical. Now, yes, the blue line is shifted out this way a little bit. How much? By $200. That's the amount you had to pay for the option. But sometimes traders will say, no, I don't like this because I don't own the shares. I can always hold on to the shares. Well, that's not really true. You could always exercise the call. If you have the $100 call, you could exercise it, pay the $100 strike or $10,000 total. Then we also have to account for the $200 that we paid for the call. And that means you have paid a total of $10,200 for 100 shares of stock. So the reason your cost basis got boosted by $200 is that that was the price that you paid for the call. But in all cases, you can see that you are just controlling 100 shares of stock. But now what happens if you put $10,000 into this $2 option? Well, now you're controlling 5,000 shares. And so to see why that can cause such big potential problems, let's take a look at these graphs right here, the one in black and the one in blue, and we're going to overlay the same chart in blue, but we're going to buy 50 contracts. And watch what it does to our graphs. Look at that, completely flattens them. It's hard to believe. But those two graphs right there, that blue and the black one, are the ones we just saw. But because the scale is so small, it's only 100 shares, now compared to 5,000 up here. See, this is the problem that people don't understand. So notice that up here, yes, you have $10,000 into the option, but you've also got 5,000 shares that you are controlling. And this slope right here is something that you're probably not used to dealing with. Yes, you might have said in the past that I'm a buyer of $10,000 worth of stock, so it's the same thing. Well, it's not, because of these deltas. Take a look at how much this is shifted up. Now also look at the maximum loss. Doesn't look like a big difference here because our scale is so compressed, but this red line lines up right here at minus 100. The blue line, remember, was lined up at minus 200. So there's much bigger losses to be made here, but the bigger risk is this slope. You are just basically falling straight out of the sky if this stock goes against you and it's something that you're just not used to dealing with. Now, yes, of course, if it goes in your favor, that's a beautiful thing. It's going to be a great ride. But the risk is that it falls. And this is the part that traders overlook because they just think that $10,000 into a position is $10,000. And they're overlooking the leverage. So always remember, in the options market, there is a dangerous type of leverage. Buying equal dollar amounts of options is extremely risky, even for professional traders. And that's because the position becomes unstable. Your deltas will be far greater than what you're used to trading. And the problem is that by the time you realize that, it just might be too late. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.